All right, guys, in this video, we'll talk about the opponents that you trade against when you're scalping. Slightly different than if you're swing trading and investing, but worth knowing who is on the side of the deal. Okay, so we've got 6 opponents. Now, some of these are kind of people as such, and some of these are different things you've got to watch out for. The first one is high frequency trading. This is dying down a bit now as I do this video in 2019. However, 2, maybe 3 years ago, real peak. They're kind of a bit of an arms race for it, but it's died off a bit. So high frequency trading really is probably, if we're talking about it kind of officially, it's on equities, it's in markets where you place a buy order, the high frequency trading firm sees that order just before it hits the market and jumps in front of you and takes that price and then sells you a higher price. That's the kind of thing. It's this flash trading. It's kind of having a peek at the prices before they hit the exchange. That was a kind of simplified example of it, but those are your potential opponents, right? It's not so much anymore, but it's still there. If you're trying to trade a price and you keep getting slipped on it, you're getting hammered by the high frequency traders because they're seeing your order coming in and they're front running it based on the fact they can see it before it hits the exchange, etc, etc, etc. So just be mindful of that. And even kind of if we dial down the kind of duration of the trade, even these people trading back and forth and making a market from side to side, those are your opponents as well. They will have algos, and we'll kind of, let's put 1 and 2 of these algos together here, but they're slightly different. They will even have algos that are perhaps making a market, lifting size up on one side, swelling size to kind of convince people to sell, then swelling size, pulling orders. Yes, there's some laws involved with the number of orders filled versus the number of orders removed from the market, but the point is that you've got to be aware of those. So those are kind of an opponent potentially for you. And also, if we're talking about HFT, let's wrap those in with ARBs, ARB algos. So ARB algos specifically in the currency market, they're triangulating the 3 currencies. Then you want to be careful that you're not caught in that. And that wouldn't affect you so much, but it's something to be aware of. You are trading against some guys with some pretty decent execution speed. But I wouldn't say that's the major one. Let's kind of go into other stuff now. Algos. So algos, whilst all kind of program trading HFT stuff is algos, what I'm kind of really alluding to here is the algos that are trading over a longer period of time. So they're like maybe they're a TWap algo, a VWap algo, a Timeslice Algo, a peg order, something like that, something that's trading bigger size but splitting up into chunks so they don't have much of an influence on the market. That's really what I mean by an algo. So you've got to be aware of that. Let's say the market is trending, there's very often, and it pulls back a bit, you might have to find that a VWap algo gets more aggressive and starts taking offers away from you because they're trying to get the best price and it's come back to the VWap and all that kind of stuff. So that obviously would work in your advantage as well, but be mindful that could be an opponent for you. Number 3, guys, is other retail scalpers. So what I mean by this is that there are other guys out there who are scalping away. Now, if you're trading a big, super liquid market like Apple, like any current big currency pair, irrelevant. Retail trader has a complete irrelevance in there. But if you're trading, let's say, a futures market that's perhaps not so big, I mean, crude oil is reasonably big, natural gas is reasonably big. At times, the order book is a little bit thin. And if someone's trading directly on the exchange, they might take those 5 contracts that you were going to have. So those could be your opponents. I wouldn't say that you worry about them too much, but they are the opponents. Prop firms, these are a bigger one if you're trading something like the bund or you're trading interest rates or something which is a favour with the prop firms. They're not so much anymore, but there used to be times when all the prop firms in London were just trading, one specific market. They were trading the bund. They were trading, one thing. They were trading on a calendar basis, and they're all trying to do the same thing. So you have to be very careful if you were trading against those guys. And it obviously worked in your favour because you kind of knew what they were going to do, but you also have to be careful that it didn't kind of take away the price that you wanted effectively. Number 5 is stop probes. I don't really know how to label this, if I'm honest. Why is stop probes like, what the hell is stop probes? Okay, stop probes is, I don't subscribe to the conspiracy theory of people pushing stuff for the markets, but there's this kind of, the markets will probe liquidity just naturally, they'll move. And so your opponent, whilst there's not a person as such, your opponent is knowing that very often places where people will put their stops will be probed, i.e. above a high. Very often the market will trade above a high and then fail. It will trade below a low and then fail. I mean, the pit, they used to do this all the time. They did actually used to push the market one way or the other, but that's something you've got to think about, is that if you're trading on a scalping perspective, a stop probe can be your best friend, especially if you're trading and fading, that kind of stuff. That was my bread and butter in the DAX. But if you're kind of on the wrong end of it, you're trading breakouts and you're going and you see the move and it pushes and it fails, it can be your worst enemy. So it's something to think about, the opponent of stop probes at key levels, at this, and you'll know if you've been trading for any amount of time that, hey, this happens, key levels get probed, they get faked out, they get this, they get that, and it can work, as I say, into your advantage, but it can also be, you know, very, very detrimental to you if you're constantly trying to follow and trade these breakouts. Number 6, again, an opponent, not really an opponent, but a liquidity stuck. What I mean by this, so if you're trading something and all liquidity dies out, i.e. pre-data, very often that happens, people pull their orders out of the bid and the offer, you are then stuck and you can't trade. And very often liquidity gets sucked at key levels as well. So let's say the market goes through a low, you may well find that all those bids disappear and the whole thing goes thin. Now that might or might not affect you, but it's going to affect potentially if you're trading directly on the exchange. Well, it will affect if you're trading directly on the exchange. It will also affect if you're trading through a broker via CFD or a spread bet, because they may well widen the spread. If you are looking 15 ticks and they suddenly widen the spread on you to 5 ticks, it was normally 1, all of a sudden that game changes. So just watch out for that liquidity suck at key levels before data. Liquidity generally isn't, if the market's quiet at lunchtime, liquidity isn't really the issue. It's volume and it's the kind of average range of the candle. Liquidity kind of sits there and waits to be filled. But specifically at those times, you know, guys, when you've got data coming out, no one wants to trade before data, or it's gone through a level and people are pulling orders, or it's starting to get quick and people are putting orders. So, you know, just watch out for that one.